about over in the sense that we've seen peak inflation as of now, and it'll start to go down a lot faster than people expect. Well, if you look at April, May, June, July 2021, year over year, what was going on in April, May, June, July of 2020? That was the worst depression, worst collapse of the U.S. economy since 1946. So yeah, not only, go back to 2020, prices are actually going down. So when you got to 2021, you would expect them to go up. That would be perfectly normal in a year-over-year comparison. There's some of the better analysts actually say, well, let's use 2019 as a base year because it was unaffected by COVID. But be that as it may, so we expect it. So the question was it transitory, in Jay Powell's famous word, or would it peter out? Well, you wouldn't find out until the fourth quarter of 2021, because if you and third quarter and fourth quarter, because if you go back to 2020, the economy was booming in the third quarter. That just as the second quarter was the greatest collapse, one of the greatest collapse. Third quarter was one of the greatest increases. So that would tend to erase the base effects, and you'd be looking at something closer to real inflation or something that might be persistent. So there, I would say when we got to September, October, November, even now we have some December data, that inflation has persisted. So it did last longer than I thought. But I'm sticking with the view that it's going to go away pretty quickly, and we've seen the peak. In last summer, I was a little uncomfortable because the Fed was saying transitory and I was saying transitory. But one of my thesis, the way I do a lot of analysis, is that the Fed is always wrong. So I was very uncomfortable being on the same side as the Fed, because maybe I'm missing something if they agree with me. But Jay Powell has thrown in the towel, and they've flipped. So now they say it's not transitory, it's here to stay. So I feel much better saying it's transitory because now I'm on the opposite side of the debate with the Fed. Although I will say what Powell did was highly political. He got renominated by President Biden. Okay. That means you have hearings. That means you're in front of the Senate, and you're going to get grilled on inflation. So he had to get on the right side of the trade, so to speak, in order to mitigate some of the damage. It's one thing to say you're ahead of the curve. It's behind the curve, rather. It's another thing to say you're still behind the curve. But he's doing the best he can. They said they're going to accelerate the taper. Yes. That implies that they're going to accelerate the liftoff, meaning the first interest rate hike sometime in late 2022. The market, at least the futures market, Fed Fund futures market, seems to agree. So he's sort of positioned himself for the political grilling, but I don't think he's analytically right. I think we're now, it did last a little longer than I expected, mostly because of gasoline and autos, but they're real things. You got to buy them. But now I expect the inflation to come down very quickly. So rising prices, here's what you have to ask yourself. Why are they going up? Okay. And is it sustainable? Is this something that's going to continue? It has nothing to do with money supply. Your typical Austrian economists, monetarists, who say, well, the Fed printed all this money and that's what's causing inflation. It's not true. The Fed has printed the money. That part's true. You can just, that's public data. They printed $5 or $6 trillion of base money, but they print it by buying bonds from the banks that, they pay for bonds with money that comes out of thin air. They get the bonds, put them on the balance sheet, and the banks get the money. What have the banks done with the money? They gave it back to the Fed in terms of excess reserves. So you're inflating you're increasing both sides of the balance sheet. You're increasing the assets and you're also increasing the excess reserves. But the money didn't go anywhere. That money did not get out into the real economy. For that, you have to look at M2, or M1, you have to look at what the banks are doing. Are they making loans? Are people borrowing money? Are the bank balance sheets blowing up? And the answer is no. They're just buying government bonds. And so, they can make money doing that as long as the Fed holds down the Fed funds rate or by extension, the repo rate. So the money's not going anywhere. That's not what's causing the inflation that we see. It is caused by really, really bad energy policies by the Biden administration. You shut down fracking, you handicap fracking, you shut down new leases for oil and natural gas exploration on federal lands. You close the Keystone XL pipeline. You do everything possible to raise the price of gasoline because they want to promote the Green New Deal, wind and solar, right, which is ridiculous. So it's not surprising we have higher energy prices, and Putin's not dumb. He sees what's going on in the U.S. He goes, hey, you're shutting down energy production. Well, I'm going to shut it down a little bit too, just to raise the price because I'm making more money. So that explains that. That's not a monetary phenomenon. That's not because the Fed's printing money, which they are. It's because Biden has completely messed up the energy supply chain. I'm not hopeful that the Biden administration will get anything right, but some of these things are one-time things. In other words, yeah, okay, you cut energy output, Putin raised prices, Saudi Arabia raised prices, or gas prices. What you have to ask yourself, is that going to keep going? Okay, it has happened. And this is where the feedback loop comes in. Well, if I spend $70 filling up my car instead of $50, that's $20 less that I have to spend on anything else. And so the history of higher energy prices is that it throws the economy into a recession. And for that, just look no further than the period from 1973 to 1982. It's a 9-year period. We had quadrupling energy prices. Energy prices went to the moon, but we had 3 recessions, 2 of which, 1974 and 1982, were at the time the worst recessions since the Great Depression. Now we've managed to break those records in 2008 and 2020, but at the time they were very bad recessions. So higher energy prices can be sustained to a point, at which point they become such a burden that you get layoffs, reduced consumption, reduced savings, et cetera, and the economy tips into a recession. So I'm not forecasting recession, but forecasting slowing growth and slowing increases in energy prices. That's definitely the forecast, because it's kind of running out of steam to sustain itself because it has adverse effects.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
The Fed's kind of irrelevant. The Fed actually doesn't matter. The real economy matters. A lot of other things matter. But the worst mistakes the Fed ever made were causing the Great Depression and causing the mortgage bubble, which led to the 2008 global financial crisis. Those are world-class mistakes. They kept rates too low for too long between 2002 and 2006, blew up the mortgage bubble and almost destroyed the world. That's a little bigger mistake than what they just did. Here's the mistake the Fed is going to make. The Fed is going to tighten into weakness. They've already said they're going to accelerate the taper. They announced a taper that would last from, started in November 2021, and it was supposed to be over by June 2022. Now, it looks like they're going to have it done by March. That means they're going to taper faster. That implies that the first rate hike, the so-called liftoff, will happen sooner. So you might even get the market saying 3 rate hikes in 2022. We'll see what happens, but I wouldn't rule that out. Everything I just described is a mistake because they are tightening into weakness. We've seen this movie before. The Fed in 2013, the Fed announced a taper. They finished the taper by 2014. They did the liftoff in December 2015. Took them almost a year to raise rates, but they did it. Then they continued to raise rates in 2016, 17, 18. What happened in October, beginning of October 2018? From October 1st to December 24th, 2018, the stock market crashed 20%. Now, as the Fed was moving towards to go, hey, we want to normalize rates. We want to normalize the balance sheet. We want to get the balance sheet down, get rates up, kind of get back to normal. But they couldn't do it. They destroyed the stock market, 20%. And that wasn't COVID. That wasn't, what happened in 2020. They did that in the last quarter, fourth quarter of 2018. So now we're watching the same thing again. Bring down the balance sheet, finish the taper, raise rates, and they're going to trash the stock market again. Well, inflation, it does drive gold prices higher. That's very clear, but it's not the only thing that drives gold prices. The best way to understand gold is think of it as a form of money, which I do. So everyone in foreign exchange trading looks at the euro, US dollar cross rate. Well, you should, because that's the largest, most liquid exchange pair traded in the world. Talking trillions of dollars a day. And when people look at dollar indices, DXY and a couple others, Fed index, so the dollar is really strong. Well, it is. But you can look at the dollar price of gold, measured by weight, and think of it as a cross exchange rate between gold, one form of money, and the dollar, another form of money. So if you want a higher dollar price for gold, which gold investors do, and that's then the dollar has to get weaker. So, but right now we're in a little king dollar episode. I mean, the dollar is crushing the euro, crushing the pound. So gold is not crashing. It's not going down a lot, but it's in a really tight range. But for gold to go up a lot higher, you're either going to need inflation, which I don't expect, or you're going to need a much weaker dollar. That will come, but not yet. So I would expect gold to kind of go sideways for a while. It will break out. It will break out to the upside, but not right away because the dollar is still king. But at some point, they're going to cheapen the dollar. Not yet, but they're going to say, "Oh, wait a second. Now the U.S. can't shoulder the entire burden of the world. We need a weaker dollar to promote our exports, promote export-related jobs, compete with Airbus, et cetera." And when they do that, then the price of gold will take off because it's just a cross rate. It's just an inverse relationship. The problem is people don't know what diversification is. Like, I run into people, they say, well, I'm diversified. I own 50 stocks in 10 different sectors, semiconductors, consumer non-durables, whatever. And I'm like, no, you're not diversified. You may have 50 stocks, but you have one asset class, which is stocks. And they're not highly correlated when you don't care, and they're extremely correlated when you do. They all go down together. They can go up together as they have, but they can go down together too. So real diversification. Have some stocks if you want, sure. I recommend a big slug of cash because it reduces volatility and gives you optionality. 10% gold. One of my best investments actually lately is a gold mine that's doing extremely well. And natural resources. I think energy stocks will do fine. Real estate is doing extremely well. So to me, diversification is, some stocks.